Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Carol Massar along with Matt Miller. Hey, we did get another inflation print this morning. U.S. wholesale inflation for the month of February stagnating thanks to a sharp decline in trade margins. We wanted to get into that with our own Michael McKee, Bloomberg News International Economics and Policy Correspondent. It is our second read on U.S. inflation. So, Mike, second one on inflation. I don't know, how do you put this together with the CPI report today? And is this kind of what the Fed is looking for?
Well, this is a little bit better in terms of the overall numbers for the Fed. However, you said the decline of the flatness was thanks to the trade numbers in there. Don't refer to international trade. It refers to the margins for wholesalers and retailers. And if their margins are going down, that's not good for profits. And Matt was talking when we were off the air about profit analysts marking down profit forecasts. So that's a little bit of bad news in there. Other than that, the parts of the PPI that get folded into the PCE, which is the Fed's inflation indicator, were stronger in most cases than anticipated. So it looks like between the CPI and the PPI that PCE is actually going to rise this month.
This is what I think is fascinating because I've been noticing lately that you and other economists, when you get CPI and PPI, you can start to put together the PCE number. And that's what the Fed cares about, right? And last time we saw it was much weaker, but now this seems to be showing that maybe prices will firm up in the PCE?
Yes, not that much, maybe 50 basis points, not a huge rise, but what it does is tell the Fed they have more work to do. And it ratifies, if doesn't necessarily encourage them to keep rates at unchanged. Now, we know they're not going to change rates next week, but this just gives them more runway to say, we don't know what's going on in the economy, so let's just sit here. And inflation gives us the reason.
What do we need to know about the weekly jobless claims number?
Jobs claims is still a surprise that it stays so low. A lot of talk about the economy maybe slowing down, but we're not seeing any evidence in terms of layoffs. Federal initial claims went up, but not even as much as last week. So we're not getting a clean read on that yet, and it'll be a while until we do, probably because of the back and forth on whether you're fired or not if you work for the federal government. But the number you want to watch, and we'll be putting this out on Bloomberg a lot over the coming weeks, is the continuing claims for federal workers, because that'll be the adding them all up, and we'll get a better idea. We don't have any idea right now exactly how many people have been fired or let go.
Yeah, I thought it was interesting when we were talking this morning. Mike was on my television show, Bloomberg Open Interest, every day from 9 to 11. And
greatest show on.
It's the best show in the history of television. Nobody's made a better show, in fact. No,
Stop that.
We were talking about whether or not this economy really belongs to President Trump, or whether or not we're still seeing the after effects of the Biden economy. I guess that's debatable, but it seems to me that you will start to see the inflation from the trade concerns come in the next slew of reports, or that you'll start to see the effects of the federal government firings in the next slew of labor reports. Is that right?
It'll take a little while for all these numbers to get in there, especially the inflation ones that go through middlemen, like the steel and aluminum tariffs. Now, in this month's PPI, we saw prices rise a lot for steel and for aluminum. And it clearly the companies were anticipating these tariffs and raised prices ahead of it. So we may see that, but then the stuff gets used and put into other things, cars being a big example. And it'll take a while for prices to go up because of that.
Motorcycles.
People have. Or motorcycles. People
I'm buying
have
a Harley Davidson this month.
Surprise.
And they use a lot of steel.
Yeah. So, you could say we'll notice it in a while. It doesn't really matter whose economy it was. It's funny. The administration's been saying this is Biden's economy, except yesterday and today when inflation was lower and they said, oh, CPI, PPI, this is Trump's economy. But it's the voters who make the decision.
Really quickly, 20 seconds. Do the tariffs have to roll back in order for there to be a strong U.S. economy later this year? With the Commerce Secretary, Howard Lutnick, seemed to say to Bloomberg Surveillance this morning. Do we have to see the tariffs roll back, though, in order to get there?
I would guess so, but we don't know what the tariffs are going to be yet. Exactly. Okay. So it's hard to make a definitive prediction.
All right. Good stuff. Mike, thank you so much. Bloomberg News International Economics and Policy Correspondent, Michael McKee.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
President Trump's trade war chaos has led to growing calls to lock in profits, sit on the sidelines, replacing the buy the dip mentality that dominated Wall Street for decades. And despite some attempts to snap up discounted stocks, S&P 500 hasn't notched 2 consecutive days of gains since its February peak, and market watchers say they do not see signs of a meaningful rebound rally yet, which can definitely make it tricky for someone who has more than $1 billion in assets under management, which is the case of our next guest. Let's head to Scottsdale, Arizona, and to Brian Vendig, Chief Investment Officer at MJP Wealth Advisors. As we mentioned, they have exactly or around $1.2 billion in assets under management. Brian, good to have you here. S&P continuing to flirt around correction territory. Curious about your clients. Have they been reaching out over the last couple of weeks as stocks have sold off?
Hey, Carol, great to speak with you again. Yes, I mean, the outreach from clients has been intense, and I think that intensity has picked up over the last couple of weeks. And look, at the end of the day, from an investor's point of view, not having that certainty to know how the extent of these policy decisions might go on varying degrees here, plus hearing that economists are talking about stagflation, recession concerns, and couple that with outlooks changing for S&P 500 growth this year and revisions to U.S. GDP, Carol, people need guidance. People need clarity to know what is the extent of this correction. And I will just say that the setup was there for some volatility going into this year as well. This is not necessarily all just policy driven. I think there's some fundamental valuation concerns about different parts of the market, because when you look under the hood, you see that there is a rotation going on between growth and value. And I think that has a lot to do with how much investors want to pay for growth right now.
Well, and the tech earnings may not be exactly what we expected. It's not unusual, right? I was looking at the Qs last year, and we had a summer swoon that was, I think, a discount of 13 or 14% in July to August on the NASDAQ 100. But the concern is you don't get the 14% growth everyone was expecting this year because you just don't have to pay as much to make a DeepSeek AI model work.
No, that's fair, Matt. I mean, I think when you look at the quality of earnings over the last couple of years, I mean, the outlooks for this year was that tech would grow about somewhere between 16 to 20% on average, and you'd get a bigger push from earnings coming from areas outside of tech, which we've talked about with our clients and our investors, and still believe that that's going to be one of the main themes over the balance of the year. But I think to your point, the reaction of DeepSeek, I think, was a little bit of a knee jerk, because as innovation normally happens, price and cost does go down, but then that improves productivity and a wider adoption. So for our clients, we are cautious in this environment for sure, because we're lowering our expectations of growth because of the uncertainty around policy. But I also still see that there are opportunities in tech when you think about the expansion and adoption through software. And maybe it's not so much of that hardware conversation that you're implying, Matt.
So, all right. First of all, where do you see those opportunities? And is it enough to make up for a drop in the massive hardware gains? I mean, if you look at the $3 trillion companies, Apple and Nvidia, if those lose their mojo, can we make it back with Microsoft or, more of a software play?
Well, I think this correction and this reevaluation of earnings multiples going forward, it's really a case-by-case basis. I think you're seeing more of active management helping us for portfolios and making those choices between company names and growth versus value. Like, let me give you an example. I mean, Apple for recently pulling back because it's delaying a launch of an AI innovation tool that surprised investors. That's a different story than possibly what we're going to hear next week from NVIDIA regarding the adoption and the ramping up of Blackwell and the next version of Blackwell, which might be even more efficient to implement from a server perspective, and what the adoption rate might be in their ecosystem going forward. So I think it's a case by case, and looking at things on a forward PE perspective, NVIDIA looks a lot more attractive now, obviously, than it did at the beginning of the year. I think the opportunity still exists in those aspects of that AI innovation trend, because it's still going to play out over the next 5 years, but you just got to be patient. It's not going to happen all in 1 year. And on the value side, we still like those names that can participate in growth moving forward, healthcare, industrials, some elements of financials. But you got to be cautious that the economic environment is changing in the short term, because the administration is looking to decouple the United States in some aspects of the global economy. So you have to be sensitive to small caps right now. You have to be sensitive to some of these companies that will get caught up in the tariff conversations, like autos and others, where there is a lot of this cross-border exchange issues that companies pay for. And that's the part that I think investors don't realize with some of these conversations, is that it's not that this extra tariff money is going to go back to the government. It's actually being absorbed by companies. And companies now are making a decision on how they're going to try to protect margins. And then, of course, the concern is, how does that play out to consumers? So we're cautious in this environment, Matt, but we're also not giving up on the U.S. capital market system.
Yeah, I'm looking at the Russell, down about 10% so far this year. Hey, Brian, just got about 30 seconds here. We talked earlier with our Ed Harrison about money moving from the U.S. to Europe. We've seen the European markets outperform easily by a wide margin. U.S. stocks as measured by the S&P 500. Are you moving money outside the U.S. for your clients, Europe or elsewhere? Just quickly.
Yeah, sure. I mean, we have an exposure to international in most of our portfolios, and we are evaluating adding to that, because it seems like the investment in countries right now are being bolstered when you think about what's coming out of China and Europe being less reliant on the U.S. and looking to invest more domestically. I think we want to get through the next couple of weeks on the tariff conversations and where these policy decisions are going to go in the beginning of April, and getting a little bit more there. But I think there is an opportunity that international equities could be a good spot for your portfolio, and also comes with a more attractive PA.
All right, good stuff. Hey, Brian, thanks so much. Good to see you again and talk with you again. Brian Vendig, Chief Investment Officer at MJP Wealth Advisors, joining us from Scottsdale, Arizona.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Got to talk about Intel jumping the most in, I think, more than 5 years. I got to check my numbers. Right now, it's up about 14%, was up almost 19% at its highs today. Company naming Lip-Bu Tan as its next chief executive officer, and trusting a former board member and semiconductor veteran with one of the toughest jobs, safe to say, in the chip industry. With what you need to know, back with us is Bloomberg News U.S. semiconductor and networking reporter Ian King. He's out there in our San Francisco bureau. I'm guessing you've had a pretty busy 24 hours or so. Ian, who is Lip-Bu Tan?
Yeah, Lip-Bu Tan is obviously, as you said, an industry veteran. He's kind of 65 years old, got into the industry really as a sort of venture capitalist, then migrated to become the CEO of an electronic design company called Cadence, arguably rescued that company from a difficult situation and built his career there. I think the defining characteristic, according to everybody we're speaking to, is that he's renowned as somebody who has the biggest network, all of the contacts, knows everybody, knows every company, knows what's going on in the industry, and they're hoping that that will be of use to Intel.
In a sense, I was thinking this morning, he's kind of like the Kamala Harris of Intel.
Wait a minute.
So,
I'm not sure what you mean.
Tell me if I'm wrong, but it seems like he plans on keeping pretty much the same strategy as Pat Gelsinger. Is he going to do something different that we know of, or do you think he has maybe an ace up his sleeve?
Yeah, I mean, that's a very good question. So to address that directly, we don't know yet. I mean, from what was publicly put out there yesterday was, as you just indicated, very much, well, we're going to stay the course here. But I think, and you're seeing that reaction in the market today, a lot of investors would quite like to see some value realized from this asset in the form of splitting it up. Maybe, as we know, his predecessor, Pat Gelsinger, was virulently opposed to that idea. Maybe he isn't. So that's one of the plays that's going on here. And also, perhaps a more realistic, maybe he uses this great contacts network that he's got to bring in some of those outside customers that Intel needs. I mean, these are all of the things that are going on in people's minds right now. But to your point, we don't know yet. We're going to see him face direct questions once he gets his kind of feet under the table next week.
Well, that's what I was going to also wonder, or I wondered, Ian, because he has such great contacts across the industry, does he help facilitate some deals? I know that we've seen Intel move higher on maybe some kind of deal with his foundry. We've seen headlines about TSMC pitching Intel Foundry as a joint venture to NVIDIA and Broadcom. That was a Reuters story. But you've been focusing on this too, about, kind of what iteration of Intel going forward, and is he the guy to kind of get it done and get it done well?
Yeah, I mean, again, I think you're going to the heart of the matter here. If Intel is to stay the course, it needs outside customers. It needs orders from NVIDIA, from Apple, from AMD, from everybody else. So you need somebody who knows how to talk to them and persuade them that Intel is no longer the big bad wolf, that it's here to help you and you should use its factories. That would help Intel to become what it wants to become, what it says it should be. On the flip side of it, if you're going to split Intel up, it's an enormously important and complex set of dependencies, set of requirements, whether it's government, whether it's customers. So there's a lot going to have to go into a deal if it's going to be split up, whether it's for the product side or whether it's for the factory side. That would require somebody who knows how to pull on these various threads and dance through the various corridors of power and boardrooms to make this happen. So maybe that's who he is as well. So could work either way, but Intel certainly has a lot of work to do ahead of it.
My biggest worry is the great state of Ohio here. Intel was going to invest, I think, $30 billion in a new fab right in between Granville and Columbus. So many businesses and consumers there had been preparing for the big windfall that would be. Are they still going to be able to do that? Is it dependent on billions of dollars from the federal government? Is Trump going to put an end to that with the sort of cancellation of the CHIPS Act?
Yeah, so what Intel have said is, look, we'll build it when it makes sense, and it doesn't make sense right now. Okay, we don't need the capacity, we're not going to build it. So in theory, if they do get some of these orders from outside companies, if they do realize, some engagements, they do get better products out there, they have more demand, then it makes sense to build Ohio. The project could come back online. And as you know from the CHIPS Act, as it stands, is basically an achievement-based system where you do a certain thing, you get a certain amount of money, you move on to the next stage and you get the money for that. So it all could come back together. But the chip industry is littered in history with what are called shells, the plants built but no equipment in them. Without the equipment, they're meaningless. Companies throughout history have built these things thinking maybe I'll need this as kind of an option, and then it never comes to pass, and that could be Ohio's fate.
Hey, Ian.
That's horrible, Carol.
I know. I'm sorry for that. Well, right.
Poor Buckeyes.
I know. Right. And the expectations of what that would do, certainly for local economies. Hey, Ian, there's naming a CEO, and then there's making sure that you've got kind of the key senior people in place for wherever the company's going. Do you anticipate that he's going to be bringing in other people? Does he need to change some teams around, or is it enough just to have the CEO with maybe be a different background and just kind of taking the company on his own forward?
There was a sense under his predecessor, Pat Gelsinger, that things got shaken up at the top. Mm-hmm. There were a lot of comings and goings of executives, and there was also the same thing under their predecessor, Brian Krzanich and Bob Swan. So it's hard. Intel used to be a company that grew its own and had a very clear succession plan, and everything would filter up. Now, we're really not sure whether it's internal folks that are the answer or whether they need talent from outside. Yeah. Going to be hard to do that, though.
So how much time does Intel have, or how much time does Tan have? In other words, how much time do investors give him to kind of figure this out?
Again, I think the very important question, the doom and gloom talk is, Intel's finished. Oh dear, it's going to fade away. It's still a very big company.
Right.
If they cut back on the spending, if they cut back on this, a plan to return to being what they were, it's a profitable company. It's a smaller company. It's not the Intel that it used to be, but it's a viable company. So there are a lot of decisions to be made here. If they still go for it, it doesn't have a lot of time, right? Because the numbers don't add up. If they retrench, if they are less ambitious, there's no time limit.
Yeah.
Intel's a $102 billion company right now.
Yeah, $50 billion in revenue, right?
NVIDIA's $2,850 billion company. There's a big discrepancy there, right? And by the way, the estimated PE for NVIDIA is 25. The estimated PE for Intel is 50.
Ian, got about 20 seconds. Any thoughts?
Yeah, you're absolutely right. I mean, the numbers do not lie. There's been a massive transfer of wealth, not only in the stock market, but reflecting where the industry has gone, away from Intel into NVIDIA. And unless Intel can do something about that, then the numbers are still going to be ugly.
All right, Ian, thanks so much. We know it's been a busy week for you. So appreciate getting some time and getting you to weigh in it. We actually, Tim and I read Ian's story as soon as it hit the terminal yesterday because we wanted to make sure we shared it with everybody. Ian King, U.S. Semiconductor Networking reporter at Bloomberg News. As we said, shares of Intel, man, they are just soaring in today's session. I think it's the top gainer in the S&P and the NASDAQ.
Biggest
100.
gain since February.
Yeah, huge.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
You might recall last week we did see a visit to the White House by executives in the crypto industry following President Trump's executive order creating a strategic Bitcoin reserve and a national stockpile of other tokens. Our next guest was at the White House Digital Assets Summit last week. Joining us is Andrew Durgee. He's co-CEO of Republic. It's a private investing platform for crypto, for startups, gaming, and real estate. Valor Equity, Galaxy Interactive, and Morgan Stanley are among its backers. Andrew joining us from Florida. Hey, Andrew, good to have you here with Matt and myself. Hey, take us to that meeting last week, kind of how it all went down.
Yeah, it really was a special experience overall. For 15 years that I've been in this space, every day has been nothing but headwinds, particularly from the U.S. government, or what I would say felt like getting punched in the face over and over again. And me and a variety of close friends and partners that have been in the trenches in the industry for a long time show up, and we got a hug from the government. So that was a very emotionally confusing moment, I think, for a variety of us. But it really showed how serious the administration is at not only looking at the space of what's coming in the future, but making sure that we can prevent what has previously happened in the past. And they really gave a forum for the industry leaders to all come together and have an opportunity to have a speaking moment and have requests and figure out what's going to be the right path over the next 4 years to make sure that change happens and change stays.
Hopefully the getting punched in the face over the last 15 years, the blow has softened as you got richer and richer if you held Bitcoin. I mean, it hasn't been that bad, right? For those who hold these digital assets. At one point, I bought a Bitcoin for $600, and a couple weeks ago, it crossed over 100,000. Is that directional? Is that direction going to continue to be up, up, up?
I love what you said there. Oftentimes people will associate this happiness with the economic growth, but that's assuming that people held the asset like indefinitely, right? And usually what I tell people, I got involved in 2010. The only difference between me and someone who got involved in 2019 is I just suffered a lot more, right? A lot of people didn't understand what was going on. A lot of people were concerned this was a scam or Ponzi or whatever. And, now we see institutions are very much involved as it relates to Bitcoin. And it's just an entirely different veil that we get to wear. And that's exciting. And what was the second part of your question?
Well, I was just wondering if you expect Bitcoin to continue to move in that direction. I mean, it has been astounding to me. I remember Joe Weisenthal.
Yeah.
I told him I loved it at 250, and he messaged me at 75 and said, "You gotta, double up now." and I wish I had, obviously.
You're still here, so I'm guessing you didn't.
Yeah, I was transacting with my Bitcoin, which is ridiculous. I bought a beer with Bitcoin.
Expensive beer.
Could buy a car with that now. But do you think we're going to go to 200,000 to 500,000? And what's your time frame for that? What are your expectations?
Yeah, listen, the reality is there's only ever going to be 21 million Bitcoin, right? That's it. And in 2034, I think 2035, 99% of that Bitcoin will be in circulation, 99.9%. So there is a real scarcity around it. And now, the comparison we always like to draw at the firm is, what is the value? If we're looking at Bitcoin as an actual gold competitor, and we compare it to what is the actual size of the gold market, Bitcoin has a long way to go still to this day. And as we're moving through, and as it's already been announced that there's a strategic Bitcoin reserve coming, and it's been announced that they are going to be buying Bitcoin. There is a scenario here, not just in the US, by the way. Obviously, we're talking about the US, but it will expand far beyond that, where governments will print money to buy Bitcoin. Now, ultimately, the U.S. commitment is it's not going to cost taxpayers any dollars, right? They're going to build a strategic reserve without additional cost to the citizens here. But every other country may not operate that way. So you're looking at a really unique dynamic, again, where governments will be printing fiat, be printing money, and ultimately to build up their Bitcoin reserves. So, yes, I think it's very much still directional.
But were you somewhat, I want to go back to the White House meeting. Weren't you somewhat disappointed? It seemed like the crypto industry was overall, I think they expected, the administration, the government to be active buyers and not just Bitcoin, but other currencies. So weren't you disappointed a little bit?
I think the industry itself definitely has very much knee-jerky reactions. It's the nature of the space in and of itself. But I think that event was a very big symbol, and symbols can be powerful. I would not ignore that, right? I can't remember if it was Tyler or Cameron Winklevoss had a really great quote, and I told them I was going to steal this in the future, so I'm doing it now, guys. Sorry. They said, a year ago they thought it would be more likely that they could be in prison rather than in the White House, right? And that's a wild thought, and they continued on beyond that to even say, right now crypto businesses are born in law firms rather than being born inside dorm rooms and garages, right? And so that is a real problem. So
that is crazy because those are a couple of the most respectable people, I think, in the crypto industry.
Yeah.
But wait. But were you disappointed? Did you expect to get more in terms? No. Okay.
What was going to happen? Like what? It's not like their bills were going to be passed in that room, right? But we had a room with there was about 30 people. You had 6 or so cabinet members and legislators, you had 4 regulators, and you had 20 industry people, give or take, something like that. Everyone had a moment to make a request and ask for something, and those asks were very, very powerful. And one of the more common ones that took place that, the 20, probably 8 to 10 people asked is they want to see legislation. The real fear is that we're going to make these executive orders and we are going to make these big moves, but 4 years from now that those can be undone. And we don't want to see that happen. We want whatever we do ultimately to have longstanding power on a go forward, so we can build a business around it.
To me, the fear is a lot of people in the crypto industry have worked for over a decade tirelessly to build a respectable industry, and obviously there have been some meme coins and I won't even say S coins along the way that kind of ruin that. And when you see a rug pull like Trump coin or Melania coin, that's got to be concerning as well, right? The president of the United States issuing a meme coin and then, was trading at $75 and then dumped everybody involved, and now it's 10. Isn't that a concern for you? Don't you want someone who's a little bit more consistent and someone who has a kind of a different image than Donald Trump to be backing this up?
I think the thing that people need to recognize is a lot of promises are made in presidential campaigns all the time, and they're often not kept. And people make commitments, and when you call on those commitments, it's, oh yeah, we'll get to that. I got to take care of this other thing. Regardless of where you sit politically, Donald Trump came in, he made a commitment to make a variety of changes. And in like the first couple months, those things are happening, right? David Sachs had a really great quote during the White House event. He said, the administration is moving faster than most startups that David Sachs has worked with, right? And that's a wild idea. Like, we're already this far in a very, very short window. What will we be longer? Now, yes, is there other things going on in Trump coin and, and other distractions? Certainly. But like, will I take those things to also get something in the longer vision? Absolutely. I think, the alternative to what is happening now was unthinkable. And so now we're in a position where we have leaders and legislators that really want to figure out how to make this work and bring innovation back to the US. One of the largest human capital flights that I know of was when we basically eliminated the industry from the US. And all the money and all of the incredibly intelligent developers were forced ultimately to leave the country. We have an opportunity to bring them back. Right. And people who I thought would never move back to the US, some of the smartest people I've ever met in my entire life, are now making their way back, and they're bringing the capital with them. And that's going to have a real impact on not only the industry, but just the economy in and of itself.
But you think they'll shake? I talked to the CEO of Tether today.
Yeah.
He came to us live from El Salvador.
And, well,
he must have just flown back. He was just he did his first trip to the US ever. Last week and this week. So he was in DC, and then he was in New York for a Cantor event over the past couple days. And that was his first time in the US.
Is that because, Andrew, you think he was afraid before this administration of the same thing as the Winklevi, that he would end up in jail?
I mean, I can't put words in his mouth, but I can't imagine that wouldn't have been a thought, right? That happened with others.
Let me ask you.
That's a real fear.
Yeah, I get that. Let me ask you a question that you're probably asked a lot. But Carol was asking me about this during the break as well. And now I'm getting a listener who writes in and says, when will we see any real utility use for Bitcoin besides just a proxy for beta risk taking? That's a little bit flippant. I think of it as digital gold, but it's a valid question.
To really do transactions.
And I'm sure, is that the ultimate goal? Is transactions what you think we eventually want to be doing with this, or how do you see it?
I mean, for the industry, payments is a real use case, and it's being done now at scale in multiple places. Bitcoin,
but you don't want to buy anything with Bitcoin, right? I mean, I asked Michael Saylor about that, and he says only if you're crazy.
Yeah. And, Mike Saylor is very much in the camp that Bitcoin's a commodity, even though it's not taxed appropriately as a commodity, but that it is a commodity. And, from a transactional perspective, in its native state, it's not great for that, fundamentally. It's a store of value. There's other things built on Bitcoin, like Bitcoin Lightning. Tether's building an L2 on Bitcoin as well. That's all moving now, which will allow it to be very transactional. But Bitcoin in its native state is very much a store of value, or like that digital gold idea, which is why a strategic reserve for that actually makes a lot of sense.
All right. We got to leave it there. Interesting stuff. I didn't even get to the headline. Did you see the Journal about the Trump family holding talks to take a financial stake in Binance?
Yes.
To be continued.
That goes right along with the Melania coin.
All right, Andrew Durgee, co-CEO of Republic, joining us from Florida.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
All right, folks, we are just about 18 minutes away from the closing bell on Wall Street. I want to point out a story on the Bloomberg today. It just reminded us about what we've seen in the municipal bond market. Biggest sell-off in more than 2 years, causing valuations to tumble, opening a buying window for investors able to withstand the volatility. Welcome to our new reality. Our next guest invests in the muni market. With us as we drive to the close, Lyle Fitterer, co-lead municipal sector and senior portfolio manager over at Baird, joining us right here in our Bloomberg Interactive Broker studio. How are you?
Good. How are you guys doing? Thanks for having me.
It's good to have you here. Trying to keep up with the headlines. How do you kind of pull in everything that we're getting out of Washington and just geopolitics, trying to figure out kind of what it means for the U.S. economy, what it means for state and local governments, how it impacts the muni market?
Yeah, I think what you're seeing going on right now is in obviously every market, right, is that people are reassessing risk in the marketplace. It's the same thing in the municipal market where What sort of federal support are you going to get on a go-forward basis? What programs are they going to cut? What's going to happen to Medicaid? How's that going to impact a healthcare organization? So for us, it means you got to take down risk, which we had already been doing in our portfolios, probably take up liquidity in your portfolios to really, from our perspective, provide ammunition for and dry powder to invest when the market gets cheaper. And we're seeing that now.
And it makes a lot of sense that the muni market would feel it worse than others because you need that federal backing in a lot of situations. And, the Doge has shown that it could get axed at a moment's notice. Where are the biggest dislocations in the market?
Right now, again, it's interesting. What happens in our market is the high grade part of the market actually reacts first. Mm-hmm. So, because things trade and so therefore they get remarked in people's portfolios, the high yield sectors actually usually that reaction takes a little bit longer. So whereas in the corporate market, you're seeing corporate credit spreads widen, you're seeing, structured product widen out a little bit. In our market, actually, higher quality names are actually leading the way as the market has sold off, which again isn't unusual. But again, I think it's actually providing an opportunity where you can go out and, there were deals priced today, I think with 5 coupons, AA rated, that were pricing at a 4 3/4 yield on the long end, which again, that's pretty attractive for a tax exempt buyer. Again, assuming that tax exemption continues.
I mean, is it a safe assumption, Lyle, that with what's going on with the U.S. federal government, that less money, if we continue along this path, is going to be going to states? And they have mandates, right? Often, right? They've got to get balanced budgets. So somewhere, things are going to be cut.
Yeah, and again, I think they're dealing with the reality already that the stimulus money has run out now. So a lot of those were still, it was part of their budget last year and potentially this year that they still had some of those funds left over. So many states and local governments didn't necessarily build that into their budget forecasting. They had it built in as if that money was going to continue into perpetuity. So they're dealing with that. Now they have to deal with the uncertainty surrounding, are they going to get cuts to other federal programs? In the end, again, maybe I'm too much of an optimist. I think they're going to realize that the impacts of this, especially for smaller state and local governments and smaller issuers in the muni market, would be substantial. And so the funding will come through. But again, there's going to be a period of volatility, and that volatility and that kind of unknown out there is what causes markets to sell off.
If we have a government shutdown, how does that affect the sector? You've seen it before, right? So what's the playbook look like?
Yeah, again, I don't know that it necessarily has spilled over hugely into the muni market before. I think there used to be you had the pre-refunded market that you couldn't do deals that would get pre-refunded because you didn't have access to treasury strips to fund those refundings. You don't have that anymore. So it would be just like any other market where, again, the uncertainty of, okay, how long are we going to shut down? What does that mean for payments that are going to state and local governments? What does that mean to payments that are going to Social Security beneficiaries? So it's the trickle down of impact. And again, all it means is uncertainty. What does the market do with uncertainty? It creates volatility. It means things probably have to get cheaper.
What if we have a recession? I mean, there's somewhat of a growth scare over the last few weeks, and I'm not saying that a recession is forecast, right?
But people are talking about it a lot more,
yes.
So you wonder.
I think a recession actually means that Treasury market probably rallies. So while munis maybe lag in that scenario, it still means that high quality muni prices go up and yields come down, which for most buyers, that means their portfolios actually appreciate in that environment. But it also means that people start to reassess then credit risk. So your lower quality issuers then start to get impacted more in that type of scenario. But again, historically, what happens in those scenarios is when interest rates come down, a recession hits, the price impact of lower yields in the Treasury market overwhelms maybe that spread widening, if you understand that. So effectively, you actually have a portfolio that could actually appreciate in value.
We had a great segment yesterday where we're kind of going through thing by thing, the equity market, the bond market, credit spreads, a lot of different factors to see whether or not they were pointing to a recession, because you can focus and kind of obsess with one indicator and say, oh my God, a recession's coming. And this was a Bloomberg opinion column by Nir Kassar, and it was just, in totality, no, it doesn't seem like recession. But I do want to ask from your vantage point.
By the way, that was a great interview.
Yeah. I know it was. But from your vantage point, Do you see anything that says to you recession?
Not at this point. So again, I think you mentioned, corporate credit spreads have held in extremely well. Now they're off 13 basis points or something, I think, off their lows on a year-to-date basis. High yields probably off a little bit more than that, but still well through their long-term averages. If you look at the muni market, even, if you look at where credit spreads are in the muni market, they're tighter than their long-term averages, especially within high yield. So again, all those markets, I think, are saying, hey, we're not headed into a recession, but they're quickly reevaluating, and that's why you're starting to see credit spreads widen. That's why you're starting to see people reassess, okay, how long is this volatility going to be out there? When are we going to get some certainty from the administration to kind of understand what's going on and give us the confidence that we can then make a rational decision and put money to work in our portfolios?
Just got 30 seconds here, but got a bond trader on the horn. He says, what's a catalyst to take risk here? Every day is a Tate bomb or a war headline.
Again, I think you got to just look at the long term. What are you getting paid in the fixed income market to take risk? And again, I think if you look at it, you would say buy higher quality securities. On a treasury right now on the long end, it's 4 3/4, somewhere around that. On a 30-year muni, I think you heard me say it earlier. I think some stuff traded today at around 4 3/4 tax exempt. If you adjust that for taxes,
hell yes,
pretty attractive. So
what I say about tax-free munis before we get started?
Paul Sweeney just goes home and swims in a pool of munis every day after work.
We used to have a reporter here years ago, and she's like, "You win the lottery, put it in tax-free munis."
And just go home and relax.
Exactly. Lyle, thanks. Great to get some time with you.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.